All right, everybody, we're going to get started. So thank you everyone for being here today. We are actually going to be broadcasting live on our webcast today. So we have agents that are joining us. So if you're joining us by webcast, wanted to say hi to you guys. Hope you can hear me okay. You're going to be able to comment on the webcast as well. So Christine will do her best to respond to your questions as we go through this process. So what I'd like to do is I'd like to introduce our speakers today. I will introduce them now, and coming up to talk is going to be Laurie Johnson from Land Home Financial. Some of you know her, some of you do not, but she does have a lot of really cool programs. The other thing that we're going to talk about today is some of the changes in the mortgage market, what we're expecting for the rest of the year and moving forward, and how that's going to impact your buyers moving forward with their mortgages. So feel free to ask questions. We'll have like a questions and answer time. You guys will get all your questions answered. Laurie's been in the business for about 140 years, so she knows pretty much everything. So you'll be really enjoy today's class, and we'll go from there. So I'll let you take over. I know you have some people to introduce as well. So I'll get out of your way.
Well, thank you.
Thank you.
Well, hello, everybody. I'm Laurie Johnson. There's a lot of new faces in here. I'm with Land Home Financial Services. We are a banker. We've been around since 1988. One of the big perks with us is that we keep in service most of our loans. About 97% of our loans we keep in service. What that means is that with our loans, after they close with us, they stay with us, so they don't get sold. A lot of the ones that do get sold would be your jumbo, which are probably 3 to 4% of our business in the jumbo market that does get sold off to a different investor. So with that being said, everyone has a folder, and we're going to go over some stuff in the folder. If you want to go ahead and open that up. Thank you. One of the first things in here is this is a mortgage cheat sheet. I call it the mortgage cheat sheet. I've had some of my real estate agents call it their mortgage Bible. They carry it around with them. It's a good tool for you for when you're writing different contracts, for you just to be knowledgeable on certain types of programs that we have, what are allowed for seller concessions, what's out there as far as the different types of programs, and what percentages your buyers have to put down. I don't want you guys to have to know how to do mortgages. That's not what this is about. It's just for you to be educated in what's out there and for when you're writing the contracts to help you for that. Okay? Here for the mortgage cheat sheet, if you look at the first page is your loan types. Okay? Some of you are very familiar with the different loan types as far as conventional, FHA, VA, and USDA. Those are your 4 loan types that are out there. Okay? All of those different loan types have different parameters and different guidelines. All right, so the first one in the conventional loan type, 97% loan to value. We can do a loan on a conventional with 3% down. So that leaves a 97% loan to value. With that credit score on here, we like to see 640 or higher. Fannie and Freddie are the investors for conventional loans. The higher the score, the better the file, the better the rate. So if you're going to go up in score, they like 660s, 680s, where you start getting your better rates. But we can do a 640. Okay. With that, PMI, your PMI will be a little bit higher. So PMI is private mortgage insurance. Everybody that doesn't put 20% down will have private mortgage insurance on their loan. Okay. If you're putting 3% down, you're going to have a higher risk because you're not putting as much money down. So your PMI will be higher. And then the next one is max seller concessions. Bless you. Seller concessions on conventional. The max seller concessions is 3%. What that means for you when you're writing a contract, you need to get seller concessions or the seller to pay some of your closing costs for your buyer. 3% is the max on a conventional. So this is a nice tool because you're going to see that all the different programs, all of our different loan types allow different types of seller concessions. Okay. The next one is conventional at 95%. 95%, same thing, except for you're putting 5% down instead of the 3% down. The PMI might be a little bit lower because your risk factor is going down a little bit, but you're still going to have the PMI. Same thing with the seller concession, 3%. All right, any questions so far on the conventional portion? All right, FHA. FHA is a 96.5. Okay, what that means is 3.5% down of the buyer's funds or gift funds. Conventional, you also can get gift funds for conventional, but it does have to be, for both programs, it has to be a family member. Okay, so they say in there that you can get from a very close friend, but you have to be able to provide proof that it's a close friend. And it's very difficult to provide proof, but it is possible to do. Okay? With the FHA, the reason some people go to FHA is because the credit scores can be lower. FHA allows credit scores to go all the way down to 580. Okay? That doesn't mean a lender allows a 580 score. Lenders have what's called overlays. So they like to see higher scores, of course, less risk again. 580 is the lowest with us. Now, you have to have what's called compensating factors. Compensating factors could be 3 months of reserves, meaning that you have 3 months of mortgage payments after you close. So at your closing table, you have reserves sitting in your bank account to be able to provide 3 months of mortgage payments. 12 months of canceled checks for rental history, so you don't have a payment shock. There's different compensating factors that come into play when you have those low scores. There's a reason you have that low of a score. So my thought is, let's try and get the score up, because a lot of things are gonna hurt the file. Your rate's gonna be higher. You're gonna have a lot more conditions. It's gonna, be a lot more stressful with that type of credit score. So let's see what's driving it down and try and bring it up to the 600 to the 620 mark. Okay. After the 620, your rate tier is better. That's like the magic number is 620. So anything under 620, you're going to have a little bit harder time. It's going to be a more challenging file. All right. FHA monthly insurance is 0.85%. It's comparable to what's PMI. So the FHA insurance, the difference is with FHA insurance, it is on there monthly, just like PMI, except for the FHA insurance stays on there for the life of the loan. It does not get removed at all. Where conventional can be removed when you have equity in the house, 20%, 25%, depending on the PMI company. They have their own rules and regulations, but it can be removed, whereas FHA cannot. Okay. Mortgage insurance premium, it's the funding fee that goes right to HUD. Everybody, when they do an FHA or any type of government loan, they have what's called a funding fee that goes directly to that government department. So ours is HUD for FHA, and they get charged 1.75%. Okay, the 1.75%, immediately we write the check and it goes right to HUD. All right, so that is a charge to the buyer, except for it gets tacked on to their loan amount. So it shows them their closing costs, and then we back it out and it gets tacked on to their loan amount. All right, so they don't have to pay that in addition to their closing costs. Max seller concessions is 6%. So FHA, you're allowed to get up to 6%. That is not what closing costs are costing in Florida right now for an FHA. They can range anywhere. If you have a standard house under 190 or 180, your closing costs are going to run around 4.25. That's pretty much all across the board, any type of lender, because everything is pretty much a flat fee now, except for the percentages that are based on either the interest per day, from the day that they close to the day, to the end of the month. So there's certain things that are done by percentages basis, but most of the things are very comparable from lender to lender with the closing fee. So 4.25 is pretty much the standard under 200 or 190 loan size. Okay. When you get higher in loan size, the amount that you need for closing costs is less. All right. Any questions so far on FHA? Okay. One of the reasons that people go FHA and not conventional is they either had bankruptcies, foreclosures, or short sales. So we have a lot of people and a lot of borrowers that would have qualified for a conventional loan based on their job history, their assets, their credit score. Perfect scenario for a conventional loan, but they may have had a bankruptcy a year ago, or they may have had a foreclosure 2 years ago. And believe it or not, your credit builds pretty quickly after those. So with that being said, we have to put them into an FHA loan. We can't put them into a conventional loan. So a lot of sellers are seeing, I mean, a lot of agents are seeing their sellers not wanting to take FHA loans. Does anybody know why they're not wanting to take FHA loans? No? Dina probably does.
I don't, I feel like, it's the seller doesn't wanna take the FHA, that's what I keep coming up. I keep coming up against, not even putting it on the, remarks. What they accept is conventional or cash.
Okay.
And so my buyers feel like they don't wanna get an FHA loan because they hear that nobody's taking it.
Right. And I keep hearing different things of that. People look at FHAs just like they look at VA loans, and for some reason, when they're taking out their buyers to look at houses, in the remarks, it's saying no VA or FHA or cash or conventional only. So now you're not only is a seller limiting themselves to the amount of buyers that can buy their house, because 50-50 right now, people go FHA, people go conventional, then maybe you have just a certain percentage that can go VA because you have to be a veteran in order to do the VA. So, but with that, now you're taking that out of the ability to be able to sell your house. So I have been asking a lot of different agents on feedback and why. And the biggest thing is because of the appraisals. So the appraisal being that an FHA appraisal, once an FHA appraisal is done on a house, it stays with that house for 6 months. Now, and everybody knows what's been going on for the last 1.5 to 2 years here. 6 months is a big change in this market. So you go from having a house maybe going for 150, and 6 months later, that house can go for 190. I mean, that's what was happening here. So now somebody that wants to sell their house, they have to still sell it for 150, which was 6 months ago if they want FHA. So that's what's been happening. That's the feedback that I have, which at the time when they got the FHA appraisal and it didn't pass, maybe it didn't come into what the seller wanted. They backed out and they said, no, we're not coming down to whatever that appraisal was. So that's where the root of the problem started, because either the house wasn't listed at really market value or really what it was supposed to sell for, and it was inflated. It may have gone into price war, highest and best, which inflated the price some more. And appraisers see this. I've talked to many appraisers, and they are not liking the inflation. They're not liking the seller concessions. So because it's pushing the house over what it actually is valued at. So when the appraisal comes in, they're appraising the house, and it's not given that $6,000 seller concessions, or it's not given that $5,000 over listing price because it went into a highest and best. Great for a seller because they think they're getting the highest and best for their house, but not great for buyer or for the market, because now they have an appraisal that was done that's now going to be locked on the house for 6 months that they're not accepting, a buyer who paid for the appraisal, and now they're not selling their house that they just went into a highest and best for. So there's a lot of things that are going around in a circle that this is all happening with, and it comes to the part of, I believe as an agent, especially if you go into a highest and best, you want to make sure that the highest and best is going to be at a value still of the house, because anybody can say they can pay whatever they want for this house. And when you get into a market like we are having an issue over under 150,000, that's where geographically in our area, that is the income limits for a couple and for a family, 150 and less. That's where their income allowed them to be pre-approved for. That was like our biggest point, was right around there. I had more pre-approvals out for under 150 than anything. So with that, any house that was out there that was 140, 142, 145, 150, they were going very fast, and agents were there was multiple offers and multiple offers. So when you go and you make an offer on a house that was listed at 145, and that's maybe pushing it because that was the highest point that they should have listed it for. Now you've gotten a highest and best, and it's gone to 152. That's what's driving that appraisal to say, no, we're appraising it at 145 because that's what it's really worth, 145. Just because you had 6 people come in and go into a price war and push that price up to 152 doesn't mean it's worth it. So that's what was happening, and it's still happening. Not as much because I think people are starting to see we can't really do the highest and best and the price wars. And I do see that there still are multiple offers on there, but as an agent, we need to say, hey, hold on. Just because we are getting multiple offers doesn't mean this is what it's going to appraise for. Okay, so just educating sellers and making sure that they're willing to come down if that does appraisal. Now, I'm not saying that every appraisal is correct. You know, there are some appraisals that I believe that aren't correct. You know, and I look at them when I get the appraisals. I look at them. I look at the different comps. I look at the comparables. You know, and I see what do they give for this having a third bedroom versus second bedroom. What do they give for another car garage? What do they give? And I go back and forth and I look and I say, okay, well, this is actually a good appraisal. I maybe would have appraised it 2,000 more, or I would have appraised it 2,000 less. So, but that's not my job. I'm not the appraiser, but that is why we're seeing a lot of the FHAs.
You
Okay.
can't fight them either.
No, and now it is,
Anybody but a VA.
yeah, except for VA. So it has also come to my attention, VAs, which we'll get to next, on a VA appraisal, it's a little bit different. So on your conventional and your FHA, we have a standard roster. On my company, we have our own appraisal department. We don't have to go through an asset management firm. So I have all appraisers on a roster, and it's a rotating roster. I don't get to pick an appraiser. I don't see the appraisers. I don't even know who they are when they get assigned. They call the agent, they make the appointment, and they go out there. But with that being said, conventionals and FHAs are harder to fight unless we fight after the fact. When I get the appraisal, then I send it over to the buyer's agent and to the buyer. Well, it came in a little bit low. Do you have some comps? Do you want to appeal this? Do you have some comps to support the value? So a lot of times the buyer's agent will go to the listing agent and say, how did you get to the 160 when we're getting 150 for our appraisal? Do you have some comps? I had one the other day, the listing agent says, well, I don't know, that's what the seller wanted to list it for. I don't have any comps to support that. I mean, really, she said that. And I was like, so they had to come and they came down. It was 130. They came down. The appraisal came in at 121. They came down. They met in the middle at 124, and the buyer's paying the difference from the 121 to the 124, and she's coming out from 130. And if you don't have the comps to support it, it's not going to be there. So I looked and I called the appraiser. And I called and I looked at all the appraisals. He says, that's the highest that I can get in there when everything is selling for 125 that has more square footage. And I looked at it and I said, you're absolutely right. I can't fight something or have the buyer's agent fight something if it's not there. So that's what happened back in 2007, 2008. We were able to talk to appraisers and talk value with them, and you know, all agents and all lenders and everything were, we need this to come in at this price, and it would inflate the price. Appraisers are saying, we're not going to let this happen again. We're going to truly appraise these houses, and if they lose the deal, they lose the deal because we can't inflate. That's what happened, and you don't want this to happen again because it was not a pretty time. Right, Tammy? Not a pretty time. It was very difficult. So with that being said, that's what's happening from what I hear from the FHA standpoint. So my suggestion would be, you see a house that doesn't allow you to have FHA, call the agent, ask the agent, what's your reason for not allowing FHA? My buyer is FHA approved, pre-approved. They can only do FHA. Why is the reason that you're not accepting it? See if you can get out of them. Is it an appraisal? Because if it's an appraisal, let's just say the appraisal was done a month ago. I guarantee if you go in with a conventional, it's probably going to be almost the same appraisal now. It's not going to be much different. So what is the reason on why they're not accepting the FHA? Okay. With FHA, they get the same home inspections as a VA, as a conventional, as a USDA. They all get a home inspector out there, and they get the same type of home inspection. The only difference with an FHA appraisal versus a conventional is FHA does a little bit more thorough of an appraisal. They have to go up in the attics. They have to make sure that there's flooring down. They have to make sure that it's more safety issues for the buyer. They have to make sure there's no broken glass. They have to make sure there's no exposed wires. There's different things that they look for that a house should be anyway. If you're going to sell your house, you better have it in a selling condition. So that's the other thing. As an agent, when you're going to list a house and you see exposed wires, or you see the flooring is ripped up, or you see a broken window, and I'm not saying that can't be hit by a conventional appraisal, because it can. If you have a very strict conventional appraiser, he will hit those things. It's not just an FHA guideline. FHA just has to do those things. So as an agent, tell them these are the things that need to be fixed and addressed. 1, before the inspection gets done. 2, before the appraisal goes out there. Because then it becomes a more prolonged thing, because then you have subject twos. Then you have to have the seller fix all the items. Then we have to get the appraiser back out there. You have to set up a new appointment. Appraiser has to go back out there, look to make sure all the items were fixed, and then they have to clear the inspection for the appraisal to give us the complete form. So we have a lot of different mechanisms that go into the loan process, and that's just the appraisal issues that are coming back. So if we go down to VA, then we'll talk about the VA appraisals, because that's a little bit different, okay? So VA loans are 100% no money down. That's the no money down from the borrower. That does not mean they don't have closing costs. They still have their own closing costs. There are just a couple things they can't pay for that are not allowables, not much anymore. They still have their closing costs. Now, that's a big thing that comes up a lot, because they are told that there's no money down, it's 100% loan. It is. It's 100% no money down payment. It doesn't mean that you don't have closing costs you have to pay for. Now, seller can pay 4% towards the VA. Yes, can they go over the 4%? Yes, but it is an underwriter discretion. There's a calculation system they do to find out if they can go over that 4% for max. You don't really need that though on a VA, especially with us. Land Home, if you actually pull out, there's a form. I think it's on your right side, the last one. I have a flyer here. We waive all of our lender fees for VA. No origination, no lender fee. So what that means is that there's no underwriting, no processing fee, which usually gets lumped into what's called an origination fee on a VA loan. VA loans are 1% usually origination. We don't charge that at all. We waive everything for our veterans and all that. The only charge that they're going to have is their credit report and their appraisal fee, which can be paid by seller concessions. Okay, if they want to buy down their rate, or if they want to do anything like that, that's on them. They can do that. They can buy that down, but we waive all of our fees on the lender side. So that makes their seller concessions a lot less than that standard 4 1/4. Now you're looking at almost 3 1/4 for the seller concessions, even 3% sometimes. Okay, so no origination or lender fees, low rates, and then must have a certificate of eligibility. So when a buyer comes to me for a pre-approval and they say that they're a veteran and they have VA benefits, the first thing that I do is have them send me over what's called their DD-214. I take a look at that, and then I actually go into the VA portal and I run their information in order to get their certificate of eligibility. Their certificate of eligibility will give me the form that says they are eligible for a VA loan. This is very important. Before I issue a pre-approval, I do this. This is something that I feel that why am I going to waste anybody's time if they are not VA approved to be able to do a loan for VA? Because VA is a little bit different. We have to go through the VA in order to order an appraisal. It's not something that can be through our company in order to order a standard appraisal. It has to go through VA. And so with that, once I get the certificate of eligibility, which usually is instant, I usually can get it really quickly. If it needs a little bit more information, it can take 7 to 14 days. Normally it doesn't. Normally I get them within 2 or 3 days. If it is something that I had to if I had to upload their DD-214 and they needed some extra information. Okay. Funding fee. Funding fee is based on how many times they've used their VA loan. They have a first time use funding fee, and then they have a second time use funding fee. That again gets tacked on to their loan amount. It's not something that they pay for at closing. Okay, their certificate of eligibility also tells me if they're exempt from the funding fee, which is very important because that's a high fee. And if somebody is exempt and I don't have that certificate of eligibility and I disclose to them and they see 2.125% on there, they're going to say, but I'm exempt. Well, and I wouldn't know that unless I had their certificate of eligibility. Okay, so, and then seller concessions, we already talked about, can go up to the 4%. Appraisals. So appraisals we order through the VA. Once we order the VA appraisal, it automatically assigns an appraiser, and I get notified on who the appraiser is. And they also then have all the information from the selling agent and the buyer's agent to be able to set up the appointment, okay? The nice thing with the VA, with appraisals, is if it does come in low, they do what's called Tidewater. It's a system in place that allows them to, if it's coming in low, you have 48 hours to fight that appraisal. So I get notification that it is in Tidewater, the appraisal is coming in low. They don't tell me what it's coming in low. I don't know how much. I don't even know what it is. They just told me it's in low, it's in Tidewater, it's coming in low. Please provide comps to support the purchase price. At that point, I go back to the agents. They go back and forth. They get all their stuff together, and then it gets submitted to the appraiser and to Tidewater in order to fight the appraisal. But you only have 48 hours. That is your window. Once that 48 hours is up, that appraisal gets sent to us and it's confirmed. And after that point, it's very difficult to fight. So the nice thing is they give you that opportunity back. So whereas your other ones don't. So if a seller doesn't know that, that's something to educate them on when you're doing your listing presentations. And they say, no, I don't want VA. And they'll say, because VA appraisals come in low. Well, I'll tell you something. My VA appraisals have probably been coming in better than my other ones right now. So, and when you have that ability, if you can't produce something in those 48 hours, that value is not there. And I have had 2 VA appraisers bring it up when I produced those documents from the agents in the last probably few months. So that is something that is a benefit to take a VA loan versus not. So inspection wise, same thing. You're getting the same home inspection. For safety reasons, yes, they're going to do the same thing almost like an FHA. They're going to look at different things. They're going to make sure there's not wood rot. There's going to make sure that it's safety. So they are a little bit more strict than your standard conventional. But that again is protecting your buyer, and the house should be in selling order in order to sell it. Okay?
I have a question.
Sure.
So I'm working with a buyer right now who's a veteran, and I am a little concerned that the appraisal is gonna be lower than the
Okay.
asking price. So you're saying that if it comes in lower, I can try to get comps from the other agent,
Yes.
and who do I?
So what they're going to do is the lender's going to get notified that it went to Tidewater. Okay. The minute it goes to Tidewater, they're going to get notified that it went there, that they don't have supporting documents to bring in the value. At that point, you and the listing agent need to get as many comps as you can to support that value. And then you submit it back to either some lenders will take it and do it that way, but it is a form, you got to fill it out. Otherwise, the agent just does it because they want to get it done and get it submitted over to that appraiser. You're more than welcome, once the appraisal, to tell the appraiser, I have, once they send it to Tidewater, I have comps. Would you like me to send them over to you? Then that appraiser will say yes. Most likely they'll say yes, send me what you have, and I'll see what we can do. So, and I can't guarantee that they will, but you're at least providing the information that you had when you either took your buyer to that house and you saw that the house was worth that, or in a selling side, when you listed the house.
Definitely make notes of any upgrades in that home because I
Yeah.
won the Tidewater one.
Yeah.
With all of that.
You may or may not change my house.
And it may not.
When I sold my house, I had plenty of comps that supported the
Yeah.
price of my home, and you just
Yeah.
continue with this thing, so.
And it is, and it's a
They-
hit or
they
miss.
They did ask for it.
Right.
You submitted, but it didn't change the outcome.
And people have to understand, it's a good point about your upgrades, because upgrades help, but they don't help like we would think. When somebody redoes a kitchen and they put $10,000 into the kitchen, you just basically brought the kitchen up to the house four houses down. That's a new construction. So you just basically brought it up to what today looks like. So this is coming from appraisers that I've talked to in depth about these certain things, because people always put so much money into their houses in order to do these upgrades, and then they want it back when they sell it. It's not there. Everything is basically done on square footage. Square footage, how many rooms are in the house and how many garages. That is the gist of an appraisal. It's going to match from, if you are trying to sell a 3-bedroom, 2-bath house at 2,000 square foot, and you're trying to compare it to a 2-bedroom house, 1,900 square foot, you're not going to get the same. Even though it's only 100 square foot different, you now are missing 100 square feet plus a bedroom. That makes a huge difference. Do we sell more 3-bedroom houses or more 2-bedroom houses? What is more asked for? That is the way that the appraisers look at it. Same with two-car garage versus one-car garage. You know, people say I have to have a two-car garage, and that is where people they go to the two-car garages over the one. So you're going to get hits for those things. You have to also look at when you see an appraisal and you're going, but why? Why is it so low? Look at all the hits that are given to your subject. Views, lake views versus non-lake views, busy roads. All these things take hits. Even though that square footage may match the one, that's half a mile away, you have to look at where the hits are. Okay? All right. I'm not going to really go over USDA loans. We do USDA loans. We just don't do them as much anymore because they've changed our maps. There's only certain areas now that have rural. We have Brooksville, Town, Royal Highlands, and some of the Shady Hills area. That's in this area. If you want more information on it, we can discuss it later. I did give a website on here for the USDA. You can check the addresses, and then once you get to the address, it'll tell you if it's USDA approved. USDA is all based on the location, and then your buyer has to be USDA pre-approved. Okay? So we talked about appraisals. The way that our appraisals work is appraisal is paid for at the time of service. It's not paid at closing. The only one that can be paid at closing is a VA. Okay. Paid at time of service means that once I send out all my initial disclosures to the buyer, so I've received my contract from you. Now I've requested what's called the prelim CD or the prelim fee sheet from the title company. I get the fee sheet, I plug in all the figures, and then I disclose to the buyer. Initial mortgage disclosures, they can electronically sign. Once they electronically sign all of those, I then send a payment link out for them to pay for the appraisal and for the appraisal to be ordered. Appraisals run anywhere from, they can be as low as $375 and go up to $450. VAs are standard $450. FHAs, most of them are $450. It's your conventionals that can run a little bit lower. Once I get the payment, then it goes to our appraisal department for them to order it, and it goes on the roster, and they pick the appraiser. They sign it to an appraiser. He picks it up or she picks it up, and then they make the appointments with the agents. Okay, so that's how that process works. And that whole thing, I never know who it's assigned to, nor do I know who gets it. Or all I get is the information that it's been assigned to an appraiser, and now it's been scheduled for Thursday at 3 o'clock. That's the only information that I have. So when agents call me and say, where's the appraisal in the process? Where's that? All I can let you know is that it's been assigned to an appraiser and that he's picked it up or she's picked it up and it's being assigned at 3:30 for Thursday. Because normally they're calling the listing agents. They all have access to MLS. They want to get in the house. They're calling the listing agent. Used to be the other way around. That's not what's happening anymore. They are now calling listing agents to get in. If it's vacant, they call the listing agent and just say, is it vacant? Can I go in at any time tomorrow? And they'll go in and do it. Okay? So that's the appraisals. Large deposits. I just want to kind of briefly touch on the large deposits. Large deposits are a big thing with loans. We have to source large deposits. Anytime that you have large deposits on your bank statements that exceed a certain percentage of your payroll, we have to source them. It used to be called mattress money. If you're depositing cash, it's either mattress money, it could be from a second job that you have, but again, it's cash that's not counted as income. Okay, we can't use those large deposits unless they're a sourceable source. What I mean by that is if you get a large deposit from an insurance claim or from a 401k or something like that, we can source that, and then we have to provide documentation for that. But if you just took $400 out of your safe, deposited it into your bank account, we can't source that. We don't know where that $400 originated from. So it all starts from where the origination started with that cash. Okay. So the reason that I bring this up is because I tell all of the buyers and borrowers this, but also I would like the agents to just kind of reiterate that through the process, don't make any large deposits. So, and the next part of this that I'd like to bring up is when you're sitting with them and you're doing your contract or you're sending them for the e-signatures, and they're going to be doing their escrow money, $500, $2,000, whatever the escrow deposit is. And they either drop off the check to you for you to do it as a courtesy and bring it to the title company, or they say that they're going to go ahead and do something with the they're going to go take it to the title company. Ask them if they're going to be taking it from a personal check. Make sure that it's not coming from your local AMSCOT, because if it's coming from AMSCOT, what did they just do? They took their $1,000 from their safe or from their mattress. went to AMSCOT and got an AMSCOT cashier's check. And with that, they take their cashier's check. I can't source that $1,000. It's not coming out of their bank account. I can't source their mattress. I can't source their safe. So now we can't use that $1,000 that they just put on that contract. So with that, now we have to go back to square one and either ask the seller, is it okay that we omit the earnest money and redo and have an addendum to the contract to omit the earnest money? Well, that's not going to happen. So now we have to say, well, now you have to go take a personal check to the title company for $1,000, give it to the title company, and then you have to wait for them to reimburse you that $1,000 that you originally did from an AMSCOT or from cash, and you need to hold on to that because you can't now deposit that into your bank account because it was never sourceable to begin with, so put it back into your safe. Does that make sense? Okay, question?
I have a question. How long does a VA appraisal stay with the house? And the same for conventional?
Okay, VA appraisal does not stay with the house at all. It's like a conventional. FHA is the only one that stays 6 months with the house. That's a good question. That happens quite often. VA does not stay. It is after that house is done, it's gone. The claim number on a VA stays with the person, not with the house. FHA, it stays with the house. So once, if they want to take another VA in 30 days and a new appraisal is done, it gets assigned to a new appraiser. Yeah, that's a very good question. So, everybody understand that? Okay, so conventional doesn't stay, USDA doesn't stay, VA does not stay. Only FHA. Okay? I'm hoping that rule does get changed fairly soon because as our market goes up, like we talked about at the beginning, 6 months is a long time. I can understand it saying maybe 3 months, but not 6. Okay? So large deposits. Anybody have questions on large deposits? So please, if your buyer hands you an AMSCOT, ask them where they got it from. Like, did they take money out of, now, if they took money, if they went to Bank of America, let's say they Bank of America, they went to Bank of America, they took $1,000 out of their Bank of America account, cash, then went across the street to AMSCOT to get a free cashier's check because Bank of America was going to charge them $5, let's say. I don't know. I'm not, I don't know how much they charge or whatever. Now they go to AMSCOT, they take their $1,000 and they do it. If I can source the same day, we can source that paper trail, we're okay. But if they take $1,000 out of Bank of America and a month later, they're holding that money, that's going to be very difficult, okay? So if you see an AMSCOT as the earnest money, question it before you take it because you can stop the problem right at the beginning and have them wait, let's go do a personal check. Another issue is if mom, dad, grandma, grandpa, aunt, uncle is going to write their $1,000 earnest money for them, have you talked to your lender about the gift? Make sure you ask that because a lot of people don't realize that gifts, I have to source the donor's gifts as well. The donor's gift, I have to source the bank statement from the donor on an FHA. I have to be able to paper source and trail where that money's coming from.
I also ran into one where the FHA, they said they had to be related.
They do. They have to be related.
Yeah.
And that's what I'm saying. It's a very fine line. And if you actually read FHA's guidelines, it can be a close family friend. And I have been battling FHA on this. I've gone back and forth with them.
No, the buyers had to be related. It was a boyfriend and a dad buying because the daughter didn't have as good credit, so the dad was.
And they wouldn't allow it?
Because, no, they would have either had to got married or include her as well.
Okay.
It was January 1 is when it changed that they have to be related.
Okay. Now, there are different ways with that. If the buyer, boyfriends and girlfriends or fiancés, whatever, if they have a joint account or if they live together, we could have sourced that they live together and then dad would have been able to do it.
Yeah.
So there's different ways that you can just kind of, and it's funny because I've had, like I said, I've had different battles with FHA many times. And my latest one was a cousin.
Yeah.
They list everybody from father-in-law, mother-in-law, foster parents, aunts, uncles, stepkids, stepmother, stepfather, not cousins. They just left cousins out. Cousins are related, but they cannot gift money. So I've been, and they said, oh, well, it's not on our list. And they're like robots. It's not on our list. And I said, but cousins are blood related. And all these other ones that I'm naming off aren't even blood related.
Yeah.
Doesn't matter, it's not on our list. Oh yeah, and I have just trails going back and forth with them. So it's amazing, but that's just how, until they, so when they were writing their They're guidelines. They just left cousins out. And now you can't use them. So, and that's how it is. So just be careful with the cash, with your escrows. Look at those earnest money checks. Verify that it's been talked to with the lender if it is going to come from a gift from a family member or something, because you can stop all these problems at the beginning that will cause a domino effect throughout the process. Okay. Credit. Once I pull credit and I do the pre-approval, please make sure that no new debt is obtained. If you can just reiterate it to them, just like I do all the time. Don't go buy a car, don't go buy furniture. Everybody gets excited. They want to go to Rooms to Go and apply for a card and buy all this furniture for their new house before they close.
Or change job.
Or change jobs in the middle of it. Yeah, that's another one too. So with that, what I would suggest is, and I've had people say, well, I just went to Rooms to Go because they were doing a special and I applied for the credit card, but I didn't buy anything. So they don't think they did anything wrong. And granted, they didn't put any money on their credit card, but they applied for a new debt. So what happens is at the end, when our underwriter goes to clear the file, they do what's called a soft pull. They look at everything. They look at to make sure that you didn't obtain any new debts. When they see, oh boy, Rooms to Go credit card just popped up, we need to find out how much is on there. And the buyer says, well, I didn't put anything on there. Now we have to call Rooms to Go, which they haven't received a bill because they didn't put any money on it. We have to call Rooms to Go. They have to search for their account. Now they have to do what's called a credit supplement to show that they did not, and they have to do a 3-way call with the buyer to make sure that they did not put any money on it and they don't have a balance and they don't have a minimum payment. That takes time. You're dealing with the credit agencies who now have to get a third party involved and then have to get your buyer involved, all in a 3-way call at the same time. That's harder than people think to verify this. So don't do anything. And tell your buyers, don't do anything. Don't give anybody your social. Don't run anything. Just don't do anything.
I had a girl go without a car for 2 weeks. She was like, my car died.
Yes.
I'm like, borrow your mom.
Yep. It stinks. And that is true. I had somebody who says, I want to go buy my truck. I want to go buy. I said, no. Wait until you're done. Then you can buy your truck. So.
Lori, do they do that soft credit pull, like, I know when we're sitting in the closing office?
No.
How far in advance do they do that?
My company, we do the soft pull. My underwriter does a soft pull while they're doing the clear to close. Okay. So when it goes back in for the clear to close, that's one of their checklists that they have to do for the clear to close. Now, what they do prior to the closing day, my company within 24 hours does what's called a verbal verification of employment. Okay. So they have to call to verify that they still work there. They just call, and we can do it in my office, and Lauren does a lot of them. My processor does a lot of them. It's just a verbal to verify who you spoke with and that so-and-so still works at the company. That's it.
But they've already done that soft pull.
They've already done the soft pull.
Before it goes pretty much to
yes,
all the
with my company. I don't know how every other company is, but they don't, once docs are released to title, they shouldn't be doing any soft pulls anymore. No company should. It should be done.
I bet lenders ask for money after it went to clear.
Oh, bless you. Yeah, see, and I don't know. Like I said, every lender is probably different, but everywhere that I've been, it's always been at the end. You know what I mean? Like when it's getting the clear. So now I have seen it to where the title company, not title company, the closer of the lender, they can be the one that does the soft pull before they send out docs. And that maybe also could have been what happened too. They could have just hit the instructions and sent the instructions, but then when they went to go pull the soft pull, something popped up. So that could have been a day or two before a closing table. You know, that can happen. I can see that. So, and then that just delays all of your closing. All right, contracts. The big thing with contracts is if you're going to do a VA or an FHA contract, there's a box on there that says VA and FHA financing. Make sure you attach your VA FHA addendum. Okay. It's in the back office of Florida Luxury. If you're Florida Luxury, it will populate, I believe, automatically when you guys pick FHA or VA. It automatically populates, right, Connor?
Yes.
Okay. So it automatically gives you that addendum. I need that addendum. Any boxes that you check on your contract, if any addendums that you have marked, I need those addendums. It's part of the contract. Now that you've marked those boxes, I need all those addendums. Okay. Let's see. Make sure the title company info is filled out. It will make everything a lot smoother if before you hand any lender a contract that all the title information is on the contract. There's a spot for it, put it in there. Make sure the more information you can give, the better. There are a lot of fidelity titles or, other companies that have multiple locations. If you just put fidelity title, I have no idea which one it is. So you need to just be a little bit more specific. You can. Sometimes if you already have a closer, some people like to use certain closers at title companies. Make sure you put their name on there because that's who we will send it to, or that's who, when we call to get their email, if it's not in the contract, that's who we'll ask for. Okay? 4-point win mitigation. This has come up a couple times in the last few weeks. 4 points are required on houses that are 40 years or older. Okay? So not every house has to get a 4-point. It's not necessary for a buyer to spend the money unless they choose to get a 4-point. The 4-point is a good inspection that an inspector will do on top of their normal inspection, but it's not required unless the house is 40 years or older. Some of the companies that I get quotes for insurance do require a 4-point on houses that are REOs or owned by banks, Fannie Mae, Freddie, or even banks, okay? That's just one of their requirements. I've seen it from a couple of the agencies, but not all of them do require that. So if you see that, sometimes it's just smart to go ahead and have them get the 4-point done if it is a Fannie or Freddie or bank owned home, okay? Wind mitigation. Wind mitigation does give them credit. So when you're ordering their home inspections for them, or if you just have them order their own home inspections, tell them that wind mitigation can give them credits on their insurance premium. If the house, I believe, I'll have to double check, but I want to say it was either 2008 or 2009 or newer. Wind mitigation is not going to do anything. So I can double check on that because the house has already been up to the latest code, I think, and they're not going to get any credit. So it's kind of a waste of money. And I think wind mitigation is costing anywhere from like $30 to $50. So some of them do it automatically with their home inspection. Some of them do an extra charge. Okay. Pre-approval process. I have a website. If you go to my website, it will give you the actual pre-approval link. On there, you just click on to get pre-approved. Apply now, I think is what it is. They can do the whole online application right there. I immediately get an email. I get actually an email that someone has started one, and then I get an email that it's been finished. Please let your buyers know to put in the notes who's referred them. Sometimes they don't, and I'm going to say probably 7 out of 10 times they don't. So please send me a text or an email and let me know you sent John Jones to my website in order to get pre-approved so I know who it's coming from. I always ask them, but I can't tell you how many people say, I don't know. Her name is Connie. That's it. That's what I get. And they don't know last names. They don't know the place that, what firm the brokerage firm you're with, nothing. So I have to do process of elimination. And then sometimes I'll text my agents and say, did you give me this one? Did you give me this one? So that's just make sure that you follow it up with who you sent. Okay. Pre-approval process. I usually can do them the same day. I like to say 24 hours, but I try to get them all done the same day. The only ones that I can't do the same day usually are the self-employed. And the reason being is because they have to send me more information. I need tax returns. And sometimes they're at work, they don't have their tax returns. So they gotta wait till the evening, send them to me, and then I can work on it tomorrow, the next day. Okay? Yes.
So within 24 hours, they can get their letter?
Mm-hmm.
Okay.
Yep. I usually get it to them pretty quick. And then, yep, same day usually. So the USDA information, if you look down here, that's that link. So if you do have somebody that's USDA pre-approved and they do want a USDA house, because it is 100% no money down, it is a great program. I used to do tons of them back in the day. But maps have changed, like I said. So there's only certain areas. So you have to look to see if they want that area. Okay? Any questions so far? Okay. All right, so what I'm going to do now is I'm just going to go over some of the neat programs that we offer. This form right here, let me do this one actually first. Have you had negative credit in the past? This form right here. This is a great tool also to carry around. Remember we spoke about why people sometimes have to go FHA when they would have been in the box for a conventional loan. This is the reason. So if you look at this form, it will actually tell you conventional. If you look at first conventional foreclosure, you need to wait 7 years from a foreclosure. Now, it says 3 years from a completion date if the borrower puts 10% down, and it has a little asterisk by it. Asterisk means down here, events might qualify for extenuating circumstances. I will tell you that over the years, there's not many extenuating circumstances that qualify for that. Very hard to prove. So with that, if somebody had a foreclosure 5 years ago, what do we have to do? Put them in FHA. Okay, they had a foreclosure 4 years ago. All right, so if you look at then short sale, 4 years from the date of the deed. The date of the deed of the property was transferred, you then can do conventional. All right, Chapter 7 bankruptcy, 4 years. And then Chapter 13, 2 years. Now, one of the big things too with the foreclosure, just let me mention this, we don't have much of this anymore because we're kind of past that 7-year mark. But if we do have people that had the foreclosures, the day the deed transfers is not the day that the buyer decided that they were going to leave their house. That house could have sat for 2 extra years before the bank took it over. It goes from the day the bank transferred the deed from the buyer's name to their name. That's the kicker. So anybody that had a foreclosure and said, yeah, but it was about, 9 years ago, 8 years ago, I need their address. I have to look it up when the deed transferred. It's the first thing to do, because otherwise, if it was, well, it only transferred 4 years ago, it sat there for all that time without being transferred over. And it just hurt you because time clock didn't start. Okay? So if you look at the bottom, the next one was FHA. We only need 3 years from a foreclosure and 3 years from a short sale, 2 years from a bankruptcy, Chapter 7, 1 year from a Chapter 13. So these are the reasons on why we go with those programs, and we have to flip them to different ones. So not everybody is always in the box for conventional. There could be one thing that just brings them to the FHA. So again, when a seller doesn't accept FHA, or when you guys aren't able to show houses because the seller doesn't accept FHA, you've just eliminated a lot of people that are FHA approved, and that's the reason why they're FHA approved. Okay? VA, of course, you have to be a veteran, you have to have your certificate of eligibility and be eligible for a VA loan, but if you look, it's a lot less time. 2 years from foreclosure, 2 years from short sale, 2 years from Chapter 7. So, okay? All right, so this form is really nice and handy for you to be able to look at if you need to go back into those dates. This form here, which is know before you buy checklist. You guys, if you want, I can send more to you. You can make copies of them. These are all the documents that your buyers will need. Okay? Now, some companies and some lenders are different. If I have a W-2 borrower, I don't necessarily always need tax returns. 90% of the time, I don't need tax returns. I need W-2s. If they are a W-2 and they're 25% or more commission-based, but still W-2, then I need tax returns. So there's always a reason, but most of the time, if you have a straight W-2 borrower, I don't need the tax returns. Okay? So this can change and fluctuate a little bit, but these are the standard items. So this is a good thing to tell them, have all these things ready because your lender's going to ask you for them. The minute I do a pre-approval and I talk to the buyer and we go over everything, Lauren, my assistant, she sends out the email to the buyers and lists everything that's needed. Okay? So then they can start gathering that and getting that all together. So I already have all of that starting to get together before you actually have a contract on the house. All right? Okay, now these forms. These 3 are our special programs that we do in-house at Land Home. All right, so we're gonna look at the power purchase, which is the one that has the 1% on it. All right, this is a conventional product. 1% is what the buyer has to invest of their own money for the down payment. Okay, this is a 97% loan, meaning they put 3% down. We're going to give them the 2%. They're going to come up with 1%. We're going to give it to them as a grant. It's completely forgiven at closing. There's no second lien. There's nothing that ever has to be repaid back. It's just forgiven. It's a gift at closing. The rate tends to be about 1/8 of a point higher than your standard conventional. PMI actually sometimes is a little bit lower because of the type of program that we're putting them in. They do not have to be a first-time home buyer. It is a 30-year fixed loan, and it does single families, condos, townhomes. I do not believe manufactured homes are on this one, okay, on the actual power purchase. There's no origination fee. And once they're done, they do have to take it's like a 20, 25-minute course. It's an online course. They take it, 10 questions I think they answer. They get a certificate. They send us a signed certificate. That's it. Okay. Income limits. There are income limits on this one. We follow what's called the Home Possible, which is a Freddie program. We follow those income limits. So income limits right now, I believe, are 59 and 63,000. I'm not sure. It depends on the area and it depends on the medium income, if it's a 59,000 or a 63. But once I do the pre-approval process, I look to see if they qualify for this program. But it is a great program.
Nothing with the credit score, does it have to be?
It does have to be a 620 credit score, but I'm gonna tell you, if it's a 620, because it's a conventional product, you're gonna get hit with rate. It's gonna be higher. So again, we like to be able to see the higher ones on the conventionals because this is a conventional program. Okay. All right. I'm gonna do the other conventional one, which is a 5%. This also follows the Freddie Mac Home Possible income guidelines. All right. This one is 5% down payment assistance, where we're still going to do a 97%. 3% is going to be towards the down payment. The other 2% is going to go towards the closing costs. The difference in this one is that it is going to be recorded as a second soft lien. It does not get recorded in the county. It gets only recorded in our company for 3 years. So if they sell or refinance within 3 years, they do have to pay back the 5% that's recorded with our company. If they don't, after 3 years, it's completely forgiven. There's no interest on it, no payments, no nothing. Okay? The other portion of this is once we give them the 5%, 3 goes towards their down, the other 2 goes towards their closing costs. We do charge a 1.75 origination fee. That is a charge. Basically, you're eating up that other 2% towards the closing costs. You still can get seller concessions on these, which is really nice. So it's kind of like double, but it's not because we're doing them as gifts. So now they can get seller concessions up to the 3% on the conventional. Okay. These are fixed rates. There's no fluctuations in them. It's the way that these programs are designed. Right now on this one, I believe the conventional one is 5.5. So your standard conventional is probably right now 4.9, 5.125. This is 5.5, but they're getting free money to walk in. Okay, that's your conventional. Same thing on this one. It's the online course. They don't have to be a first-time home buyer. And I think there's anything else I'm forgetting on that. Oh, this one also you can do manufactured homes on that one. Okay. FHA, you also can do manufactured homes if you need to. Single family. This one right here is your house to home up to 4%. This is the FHA. Okay, so they need 3.5% for the down payment, which leaves them another 0.5% towards their closing costs. The kicker on this one is you still have a 1.75 origination fee. And the interest rate on this one again is 5.5 right now. So with this, there is no soft lien though. There's no soft second. It never has to be paid back. It's not even a 3 years. So again, somebody needs to go the conventional route. We put them in. If somebody needs to go the FHA route, we put them into this one. The nice thing about this one is you can get more seller concessions because it's just FHA. So what my suggestion is, because we have an origination fee on here, your closing costs are going to be a little bit higher. So instead of the 4.25, you're going to want to get right around like 5.25 or 5%. Hopefully they have money to put their own money into it a little bit because we're giving their full down payment. Hopefully they have some money to be able to bring. Now, their earnest money does go towards their closing costs. So that will come off of their closing costs. Okay. With this one, same exact thing. You have the online course that you have to take. All right, and it does not have to be first-time home buyers. The big kicker with these, you don't have to be first-time home buyers, but at the time that you close, you cannot own a house. So if somebody's doing a simultaneous closing, they're selling their house to be able to buy another house, they can use this. They just have to have closed either the morning of or the day before, and not own a house at the time that they close. Okay. One of the things I do want to mention is rates are supposed to be going up. September 25th is the day. So that is right now in the works of them raising a little bit. They were supposed to raise them again, I believe in June, and they postponed it until September 25th. Now, if it's going to be postponed again, I'm not sure, but that's the date that they're looking at. Okay.
I was trying to ask her what exactly you're saying, what's gonna be raised?
The interest rates.
Interest rates for some of y'all.
Okay, interest rates for all types of loans. So the interest rates are, right now they fluctuate. They go, I mean, every day rates can change, but they're actually set to raise on the 25th. So what they do is the Federal Reserve meets, they have a big talk, and they say, okay, we need to raise the interest rates. Because about 2 years ago, we were at 3.5 on a conventional 3.75. Now we're all the way up to almost 5. So now they're going to raise probably another 1/8 or even a quarter. I mean, it's kind of, but it needs to happen in order to keep our economy going. It's a smart thing. It's just hard because when the market keeps going up the way that it does, people can't afford both the market going up and the increase in rate. So, but again, I don't know if it's exactly going to happen, but that's what's set to happen. So, any questions?
I do have more.
Sure.
What is actually the seller's concession?
So it's when the seller can pay any amount of money towards the buyer's closing costs. So that's why they have certain percentages. So on the conventional, they can pay up to 3% of the buyer's closing costs. So on a $100,000 purchase price, a seller can pay $3,000 towards the buyer's closing costs. On a FHA, they can pay up to $6,000 because they can pay 6%. On a VA, $4,000.
And that'll be negotiated when we're doing.
Yes.
Because
Yes.
That's the limit up to what you can do.
Correct.
Okay.
Yep.
And I think there was one more question about something. Oh, what is examples of a compensating?
Examples of compensating factors
Yeah.
would be reserves. So if they have 3 or 6 months reserves, meaning that when they go to close, if the mortgage payment was $1,000 a month, they would need $3,000 sitting in their bank account to show that they have enough to pay the mortgage for 3 months. That's a compensating factor. Another compensating factor would be 12 months canceled checks for rent. So you've actually been paying rent for 12 months, not living family or living at home for free. You're actually paying rent to show that's a compensating factor. Okay?
Thank you.
Sure. Anything else? All right. All right, well, that is it. Thank you everyone very much for coming. I don't know. Turn this off. Turn this off.
Thank you, Miss Laurie.